All right, let's dive right into this explainer. We're going to uncover the actual root causes behind India's economic challenges. We frequently hear these big headline numbers, like a stellar 7.7% GDP growth. But today, we're moving way beyond those headlines to understand the reality on the ground. We're going to look at the intersection of everyday household budgets, massive macroeconomic shifts, and long-term global trends, really trying to see what is actually shaping India's future. So here's our roadmap for today. We'll be covering 1. The silent middle class crisis, 2. Currency, oil and gold, 3. The manufacturing competitiveness gap, and 4. AI, automation, and tomorrow. Kicking things off with Section 1, the silent middle class crisis. On paper, it looks like salaries are rising, but there is a massive disconnect with actual purchasing power. It really all comes down to what's called the nominal wage trap. Your income goes up. Maybe you get a nice promotion, but the cost of your life is rising even faster. We have to recognize that while official inflation might hover around 4%, the real-world inflation for unavoidable expenses, things like housing, education, and healthcare, hits much closer to 10 or even 12%. And when traditional safe investments like fixed deposits are yielding around 7%, you aren't actually saving. You are essentially watching your capital dissolve against real inflation. And you can literally see the severity of the squeeze in the macro data. India's household savings rate has plummeted to roughly 18% of GDP. That's the lowest level we've seen in years. Because families are paying market-linked prices for essential services without massive social safety nets to fall back on, they're increasingly forced to fund daily survival and rising EMIs with high-interest consumption debt. Now, nowhere is this affordability crisis more glaring than in real estate. Get this. It's a massive paradox. India has a housing shortage of nearly 1.9 crore homes, right? Yet only 12% of new market supply is for affordable housing. Over 50% is for luxury homes priced beyond 1.5 crore rupees. This market is heavily skewed by massive foreign remittances projected at around $129 billion. That completely transforms real estate into a high-priced investment asset class rather than just accessible shelter for the average citizen. So, what's the big takeaway here? As a citizen or investor, you've absolutely got to adapt your financial mindset to outpace this hidden inflation. That means shifting away from low-yield safety nets and moving toward growth assets. You need to fiercely avoid high-interest consumption debt and really understand that traditional real estate might not be the guaranteed, affordable stepping stone it was for previous generations. Moving right along to Section 2, currency, oil, and gold. Over recent years, we've all watched the rupee slide from around 83 to the dollar all the way down to 95. And people love to point fingers at a single event. But let's be real, this drop wasn't just some overnight exogenous shock. It was the result of pre-existing fault lines. We're talking heavy U.S. tariffs on Indian exports, a widening current account deficit, shrinking interest rate differentials, and finally, a geopolitical conflict spiking oil prices and triggering massive foreign investor outflows. The structure was already under immense pressure. The geopolitics just exposed it. When you actually look at the raw data, the math is frankly inescapable. Think about it. We import roughly 85% of our crude oil, and we pay for it in US dollars. So whenever global conflicts erupt and oil prices spike, boom, we suddenly have a massive $40 to $50 billion shortfall. Add to that $24 billion in foreign portfolio investors yanking their money out in just a few months, and a trade deficit crossing $300 billion, these are the deep structural realities that fundamentally destabilize the currency. So how do everyday people respond to a falling currency and negative real yields? Well, they do something completely rational. They turn to a culturally embedded store of value, gold. As gold prices surged globally, the value of household gold in India saw this unprecedented increase of 117 trillion rupees in a single year. That's a massive passive wealth effect. It acts as a quiet economic stabilizer, giving families higher borrowing capacity and perceived financial security, without them even having to sell the asset. But here is where things get really fascinating. This creates a profound tension between micro and macroeconomics. For an individual family, gold is incredibly rational. It perfectly protects savings from financial repression and inflation. But for the nation as a whole, we import 800 tons of gold a year and produce only about 1 ton domestically. So the very asset protecting a family's wealth is actively draining dollars from the country and severely damaging the nation's trade balance. So what's the bottom line here? Policymakers need to realize that simply telling people to stop buying gold, it's not going to work. You have to address the root causes of their financial anxiety. Furthermore, accelerating domestic energy transition is no longer just a nice environmental goal. It is a hard-nosed national security requirement. And financially, while the RBI has massive reserves to prevent sudden currency crashes, India desperately needs to deepen its corporate bond markets to attract and retain patient long-term capital.
All right, on to Section 3, the manufacturing competitiveness gap.
Now, textbook economics tells us that a weaker currency should make our exports cheaper globally, right? It should cause an export boom. So why have our exports actually fallen from 25% to 21% of GDP? The harsh reality is that a depreciated currency simply cannot overcome a domestic environment where the fundamental cost of doing business is prohibitively high.
It basically boils down to these hidden structural costs that are baked into the system. First up, inflated logistics. Manufacturers pay heavy taxes on diesel and petrol, but they can't recoup these costs through the input tax credit system like they can with other goods. Second, energy pricing. Industries are paying incredibly high commercial electricity rates specifically to subsidize cheap or sometimes free power for residential and agricultural use. And third, vulnerable supply chains. Sure, we might assemble medicines here, but 70% of the active pharmaceutical ingredients, the raw materials, come from China. These embedded inefficiencies severely strip away our global competitiveness. And on top of that, if we want to actually compete against highly optimized nations like Vietnam or China, we absolutely need cohesive policy. Currently, a lot of Indian states require an entrepreneur to negotiate incentives on a case-by-case basis. Compare that to places like Gujarat or Tamil Nadu, or international competitors, who consistently offer unified, highly predictable policies for manufacturers across specific sectors. Capital always flows to where the rules are clear and frictionless.
So, the crucial takeaway for both business and government is this. Manufacturing simply cannot scale on cheap labor alone. We must systematically eliminate these embedded inefficiencies. We've got to reform tax credits on industrial fuels, standardize incentives across all state lines, and critically, build end-to-end supply chain depth so we aren't completely reliant on imported raw materials.
Finally, let's look at Section 4, AI, automation, and tomorrow. Looking beyond inflation and manufacturing, emerging technologies are about to fundamentally reshape the entire labor market. And the immediate defense against this technological displacement? Proactive adoption. As the source material points out, the key is to stop doing the grind work. You need to sit down with a large language model, really learn how to use it, and automate the repetitive parts of your day. Doing that frees up your mental bandwidth for high-value creative problem solving, which are exactly the things AI struggles to replicate. And the scale of this coming shift is just massive. It is not just tech workers who need to be paying attention here. Even traditional, high-touch, high-employment sectors, like hospitality, are inevitably going to adopt robotics and automation over human labor to cut costs and maximize efficiency. From entry-level servers to routine logistics, jobs are going to transform or, in some cases, vanish entirely. The takeaway here is incredibly urgent. Whether you're a student or a seasoned professional, you absolutely must reskill to manage AI workflows. You should also be actively reading global sources, like the South China Morning Post, for example, to track macro shifts and understand where the world is heading before it hits your local market. Prepare for severe disruptions, and make sure you are positioned as the person managing the automation, not the one being replaced by it. So as we wrap up this explainer, we've connected a lot of dots today. We've seen how household inflation drives gold demand, how that exact demand pressures our currency, how hidden taxes hold back our manufacturing, and how AI is threatening to disrupt the labor force. It is all connected, like a giant puzzle. I want to leave you with this vital question to consider. As these structural forces collide, how will India fundamentally redesign its economic framework to ensure that our future growth is truly inclusive? Thank you so much for exploring this with me today.